Well, friends at Goldman Sachs have got another list. This time it's buy these 50 cheap stocks that have low labour costs. You can see why they'd want that. I've used the US spelling for labour because it was Goldman Sachs out in New York who came out with this report, as wage inflation stays high for now. So which stocks catch their eye? Well, there's the full list for you. That's quite a large list, and in the past, like CDW, I've owned. It's done rather well. Then we've got out of it because we hold things for 12 months and then exit. So which ones of these have gone through our filter, which is more stringent than Goldman Sachs is, because we add on a layer of valuation. So we look at the profitability of the company relative to its share price and the share price relative to the rate at which the profits are growing. We look at revenue growth. We look at discount cash flow. We also look at cash return on capital invested. We look at momentum. We look at the volatility of the company, and from what the research shows, volatility and its correlation to share price performance. So we look through a whole load of things and then create our approved filtered list. And these are the names which make my list: Archer Daniels, AmerisourceBergen, McKesson, On Semiconductor Corporation. Now, on top of that, let's just have a look at some of those. Archer Daniels, that's what it looks like. Nice, strong upward trend since 2020. And you can sort of see the direction of travel. You can see what we'd anticipate that to continue doing. These Bs mean when big companies have put a buy recommendation on it. AmerisourceBergen, same kind of thing. You can see the nice little upward trend and the direction of travel. And if it goes below that, well, you know to get out. McKesson Corporation, well, we first got into this in January of this year. And you might as well, you're a bit late to the party, Albert. You could have got in January of last year, in 2021. Yes, I wish, but we didn't. And it's fine. You can see the solid returns that have been made since then as well. And finally, the last one is On Semiconductor. And similar kind of story. Now, it wasn't because of the trend. That had nothing to do with it. We look at the three most important documents a company produces: its balance sheet, its profit and loss account, and its cash flow. And we go through those things. Then it just so happens, when you look at the charts, it sort of ties in with what fundamentally those things show. Now, we hold things for 12 months. If they drop 25% from the peak since we bought them, we exit. But there might be other exit rules, such as if it goes below a long-term support, etc. That can change and vary and be customized for the individual stock. If you'd like to learn a lot more about how to invest better, whether for your SIP, pension, ISA, 401k, your Roth IRA, whatever else it is, have a look at my campaign for $1million.com. A ton of free resources in there. I'll say that again, free resources in there to make you into a better investor and understand how to build a portfolio which isn't overwhelming, know when to exit, something which isn't time consuming, and something which should beat inflation. Should. Nothing's ever guaranteed, but should beat inflation.